So good evening, everyone. My name is Edwin Gituko. I work at EGM Securities as a relationship manager, dealing with institutional business. I also double up as a trainer in our training department. So I'm glad that you could be able to join us this chilly evening. And the agenda for today, we will start with the introductions. Then we'll have our main presenter taking us off. Then towards the end, we will do a very short demonstration of how to do the basic commands on our trading platform. Then we shall conclude with a Q&A. So joining us today is Karaoke Gitao. Karaoke has over 6 years experience in global and local capital and financial markets, and is currently the business development manager at Nairobi Securities Exchange. He played a key part in the launch and operationalization of the NSE Derivatives market that kicked off in July 2019. Previously, he worked as the equities and derivatives specialist at the NSE and a global financial markets analyst at Futures First Kenya Limited, focusing on American grain futures contracts. He also worked for a short stint in the external audit team at Deloitte East Africa. He is a CFA charter holder and holds an undergraduate degree in law from University of Nairobi, as well as a certified public accountant certification. He has also undertaken extensive courses in the mechanics of derivatives and financial products from Middlesex University. Also, we have Geoffrey Redier. He's currently the risk manager, derivatives market at Nairobi Securities Exchange. He joined NSE Derivatives team in 2017 and was an integral part of the launch of the market in 2019. He continues to work closely with market participants, investors, and regulators to grow and deepen the derivatives market in Kenya. Geoffrey previously worked as a derivatives dealer and analyst at Constellation Capital in South Africa. At Constellation Capital, he traded equity futures and options on the Johannesburg Stock Exchange. And he also worked with various asset managers, hedge funds, and high net worth individuals on derivatives trading, strategies, and management of derivatives portfolios. He also worked as an investment analyst at Harbour Capital Limited, where he handled transactions in real estate, corporate finance, and private equity. Geoffrey holds a first-class honors in Bachelor's of Commerce degree in finance, and this is from University of Cape Town. So I think with that, we can kick it off, and I'll hand over to Karaoke Gitao to take us through.
Thanks, Edwin. I think you'll be my cue in case I am not clear or audible. So thank you for the introduction. Yeah, thank you for the introduction. So happy to be here, first of all, and thank you for the opportunity. So I'll walk the participants through the derivatives market walkthrough, just give them an idea of what we are doing, products available, sort of fees that they can look at, in addition to just benefits and risks of the market. Then my colleague Geoffrey will be on hand just to assist with the Q&A that pops up on the chat. But as soon as I conclude, then we can also handle Q&A, just post the demo. So I can begin. So NSE and Next. So NSE was really founded in 1954 and is the leading financial market infrastructure in the region, just facilitating trading, clearing, and settlement of financial market transactions. So we had a broad pool of products, so covering your normal traditional and alternatives. So traditional in the sense that you have your equities or shares, then you have your bonds, then you have derivatives, forming part of quasi-traditional stroke alternatives. Then you have your exchange traded funds, ETFs, then you have your REITs, real estate investment trusts, which form part of the alternative investments that we do have now. In terms of Next really was a word we coined when coming up with the derivatives market, like the next market. So it's a NSE Derivatives market in short, and it was launched in July 2019. So yeah, about 22 months in operation, and we offer futures contracts at the moment based off of an equity index and a select number of stocks, and we'll come to that discussion shortly. So in terms of derivatives, I'm sure a lot of people have heard the word derivatives and probably are asking themselves what derivatives are. Derivatives really are financial instruments whose value and characteristics are really depend on the value and characteristics of an underlying asset. So it's a derived asset class, and that's why the name derivatives came from. So derivatives really had their origin from the rice markets in Japan, where farmers really had the opportunity to fix prices on their rice, and this ideally was further enhanced now when traders in America at the Chicago Board of Trade really then were able to, due to the issues in America, sort of like weather constraints. So you'd find that the issues of transportation for wheat, corn, soybeans was an issue. And so farmers could not get good price for their crops. So what did they decide to do? So they decided to come up with sort of a mechanism in which they were able to fix a price on their products or produce, and then they are able to sell to ideally buyers who are ready and willing to buy their produce. So in terms of textbook definition of derivatives, really these are financial instruments, as you said, whose value and characteristics depend upon the value and characteristics of an underlying asset. That underlying asset really can be anything that you want to tailor it on. So it can be shares, so equities, can be bonds, so that's on the fixed income space. It can be commodities, where they originated from. When discussing wheat, corn, soybean futures in America, they can be currencies. What you find a lot of players, especially on the FXPesa trading. It can be some markets have even become as sophisticated as creating derivatives on weather. So really, if you have an underlying asset and you can easily quantify and price that underlying asset, then you can tailor a derivative contract off of it. So really, by its nature, a derivative is just a contract between two or more parties to exchange a specific asset at a pre-agreed price on a specified date. And so it gives ideally investors ways in which they can fix their prices, so thereby managing risks associated with the underlying security, protect against fluctuations in value, and ideally from a speculative angle, what a lot of clients on FXPesa do, just try and profit from market movements. So it caters to a lot of investors, and each investor comes onto market to meet any specific goal that they have, and ideally benefit from this market. So in terms of types, I'll go to types and then types of derivatives markets, and then quickly just touch upon the types of derivatives that we have. So we have two types of derivative markets. So we have what are known as over-the-counter or OTC derivatives, and we have what are known as exchange-traded derivatives, ETD. So OTC derivative markets really are sort of like markets whereby buyers and sellers interface directly. So you have more or less bilateral agreements between a buyer and a seller or between counterparties, really to exchange a specific asset in future. For example, me and Edwin, just an example, can agree to I can agree to sell Edwin my laptop at 100,000 shillings 3 months from now. That's sort of like a derivative contract, and it's over the counter because we've bilaterally agreed between ourselves, and really the terms are coined by us, and we agree on the technicalities of that contract. On the other hand, you have an exchange traded derivatives or ETD. So for exchange traded derivatives, we have the exchange taking the proactive lead in terms of structuring contracts. So depending on market demand, market appetite, or needs that are various players in the underlying market need to cater to, then the exchange will structure derivative contracts with standardized specifications, and then these contracts are listed on an exchange, and then they're able to be traded like just normal securities on an exchange. So it goes without saying that for the NSE that we do have exchange traded derivatives at the moment. However, and these are the first exchange traded derivatives we have in sub-Saharan Africa outside of Johannesburg, which is a much more advanced market. So we are the second market in Africa to offer exchange traded derivatives. In terms of over the counter, these have been there in the Kenyan markets and most markets, let's say in sub-Saharan Africa, but these are the preserve of banks. So banks do a lot of over the counter transactions. So if you've heard of any names such as forward contracts by banks or interest rate swaps or cross-currency swaps, then these are types of derivatives, but they are traded OTC or over the counter. So these have been there, but as we'll just note shortly, that over the counter do bring a bit of challenges that the exchange traded markets came to assist with. So again, we ask ourselves, so why derivatives? Why do people use derivatives? Why did the NSE think of coming up with a derivatives market? So there are a number of reasons as to why we decided to come up with this market, and some of these really are shown there. So there was increased volatility in assets in local and international financial markets. So we've seen that what the COVID pandemic has done over the last give or take 14 months, and it's brought a lot of volatility in asset prices, and really this market is there to assist with investors being able to smooth out profits, being able to smooth out how their portfolios look like and their returns, and ideally assist with that. Additionally, on our end, really, we needed to have integration of the Kenyan financial markets with international markets. So key for us, especially in terms of obtaining World Federation of Exchange, WFE, full member status, was to have a fully fledged derivatives market and a clearinghouse to assist with this. And this also now assisted us to integrate with various international markets and international investors who use these products in their jurisdictions. Another key reason as to why the NSE decided to go this route is counterparty credit risk in the OTC markets. Remember, we said OTC markets are bilaterally agreed contracts. So between the buyer and the seller, one of the parties might decide not to honor or fulfill their obligations. So there's counterparty credit risk inherent in OTC markets. So the exchange traded markets, by virtue of having an exchange, come in between the buyers and the sellers, so interface between the buyers and the sellers through a process called novation, then we are able to reduce that counterparty credit risk to almost nil. And this ideally would assist a lot of investors just have confidence that the sanctity of the market will be maintained. Key to this also, again, was the need to have sophisticated risk management tools. So remember, we said derivatives are coined off of an underlying asset or an underlying security for that matter. So if you have, let's say, a portfolio of shares, a portfolio of bonds, and you're uncertain about performance of those shares, you're not sure whether the shares will go up or down, then derivatives come and assist in really managing risk, in that you can take an offsetting position off of the same underlying security just to manage your risk and ensure smoothing out of your profits and returns. And then really there was need to have a diversified product offering for the exchange. As you said, we've been here since 1954. We have different kinds of product coverage. So we needed to diversify product offering and ideally expand the market to what is known as a two-way market. So the only way in which investors have known how to make money in the NSE or at the NSE is buy a share, wait for it to appreciate, and then ideally exit or wait for dividends or what have you. So in case that share or security declines or dips, then investors really have no, their portfolios lose money. And so there was a way in which we needed to create a two-directional market whereby investors, whether the market was going up or down, investors really had an avenue in which then they could be able to profit or take advantage, ideally again, either from profit from market movements or ideally then hedge or manage risk in their portfolios. So quickly, just touching on what we have available in terms of contracts and trading fees. So as we said, we offer futures contracts. So there are two types of derivatives markets, as we said. There are OTC markets, and then there are exchange-traded derivatives, ETDs. In terms of the specific types of derivatives that we do have four kinds of derivatives. So we have what are known as forward contracts. Then we have futures contracts. Then we have option contracts, and then we have swap contracts. So forwards and futures contracts are contracts which allow an investor to buy or sell a specified asset at a specified date, at a specified price in future. So forwards and futures create rights and obligations to the counterparties or the buyers and the sellers, and ideally they lock in the price in which they agree to trade. So the difference between forwards and futures again then will be on the markets in which they trade. Forward contracts trade on OTC markets or over-the-counter markets, whereas futures contracts again do trade on exchange-traded markets, ETD. The third category of derivatives are option contracts. Option contracts give an investor the right, but not an obligation to buy or sell a specified asset in future. And think of option contracts really like your insurance cover or medical cover. If you're sick, you go to hospital and you utilize your medical insurance cover. For option contracts, they work in a similar manner. If an asset or if a price is in your favor, then you have really, again, we can use the word, the option to exercise that contract. So it gives you the right, but not an obligation. Options have the dual nature of being able to be traded both OTC, over the counter, or on exchange traded markets. The last category is swap contracts, where counterparties agree to exchange predetermined cash flows on a future date. And this mostly occur on OTC markets, actually exclusively occur on OTC markets. And you find a lot of banks doing this, doing cross-currency swaps between different currencies and on different interest rates. So in terms of available contracts for the NSE, so we've said that exchange-traded derivatives, you can only have futures contracts and option contracts. So the NSE has futures contracts listed at the exchange, and the futures contracts have underlyings tailored of the NSE 25 index and a select number of single stocks. So for the NSE 25 index, so just as a brief background, so the NSE 25 represents a basket of 25 stocks, 25 or more liquid, more traded stocks at the NSE. So you'll find your blue chips there, your Safaricoms, your KCBs, equities, EABL, BATs, Jubilees, NMGs. The more liquid counters do trade there. And then now you do have single stock futures. So futures contracts off of a select number of shares listed at the NSE, and we'll come to that. So remember, we said that for exchange traded contracts, the exchange tailors those contracts. So it has specified tailored specifications on those contracts. And for the NSE 25, I'll quickly just walk you through some of the salient features of the NSE 25. So this is what a structured contract at the NSE will look like. So it has the underlying asset, so it has the contract size, then it has a minimum price movement, then it has contract months, settlement price, and expiry dates. So quickly for the NSE 25, just walking you through the same, the underlying asset is the NSE 25 share index. We said it's an index that has a basket of 25 more liquid stocks at the NSE. Contract size then is the notional exposure or the turnover or the exposure that you'd have by trading one NSE 25 index futures contract. So just as a quick example, as you say there, one index point equals 100 Kenya shillings. So if the NSE 25 share index, if you look at the end of the day for the price list, which has the NSE 25 share index, and then if NSE 25 share index is trading at 3,500 points, for instance. So for you to purchase, for you actually to get exposure of one NSE 25 index contract will be 3,500 times 100. That's 350,000 in contract size. However, this is not the amount that you need for you to get exposure or for you to purchase one index futures contract. And I'll just explain that shortly. So for the for futures contracts, and this is a key distinction between futures contracts and the actual, let's say, normal shares. For you to buy 1 million shares of Safaricom, you'd need to pay, it's currently trading at about 40 shillings, will be 40 times 1 million, so 40 million. For futures positions, for you to get exposure worth 40 million in the futures market, you don't need to pay the exact 40 million. You only pay a fraction of that. And this is why futures markets and derivatives markets are very lucrative through a concept known as leveraging. So you only pay a fraction of that. Give it a ballpark of, let's say, 10%, then you'd only need to pay 4 million and you get an exposure of 40 million, similar to someone who's paid 40 million in the underlying market to get exposure worth 40 million. So you see your cost of investment is much lower, and your utilization of funds, cost of funds, as finance professionals call it, is much better, and you're able then to manage your portfolio much better. So the contract size then determines how much, again, then you'll be able to spend. So let's say it's 350,000, 10% of that means 35,000. So you'll pay an upfront fee of 35,000 in initial margin. And then you'll be able to get exposure into the NSE 25 index futures. Minimum price movement, this is really how it moves on a trade-to-trade basis. So it moves per index point. So let's say it's at 3,500. So it moves in incrementals of one index point. So it can move from 3,500 to 3,501 and 3,499. And each movement equates to either a profit or a loss of 100 shillings, depending on the side of the market you're on. Contract months, we list quarterly contracts. So there's a March expiry, there's a June expiry, there's a September expiry, and there's a December expiry. So we have quarterly cycles, and ideally investors are able to take exposure in any of those months, depending on their view on the market or how long they want to remain exposed to the futures market. Settlement, we settle it in cash, in Kenya shillings. Settlement price, we do have there what is known as VWAP. VWAP is volume weighted average price for liquid contracts. So if a contract trades, then we are able to calculate the volume weighted average price of that contract. If the contract does not trade, then we still have to calculate a settlement price for this contract. Remember, we are trading a futures contract. So that futures contracts every day, even if it does not trade, every day it edges towards maturity. So similar to the way you price bonds, every day they come close to maturity. It's just a similar concept to how you price futures contracts that do not trade. And we have the theoretical price there as spot plus cost of carry. So cost of carry, really, just to explain it, spot is the underlying or normal share price, for example, and then cost of carry really is the cost of holding that futures contract. Remember, you're not holding the underlying, you don't have an exposure in the underlying, you're holding a contract. So the cost of you holding a contract, of course, you have benefits of holding that contract, and you have costs again of holding that contract. And then you have your expiry dates being the third Thursday of every expiry month. So we say they are quarterly contracts. So third Thursday of March, third Thursday of June, third Thursday of September, third Thursday of December. So for single stock futures, these are the other products that we do have offered at the next market. So the underlying asset is the qualifying stock or share. So we do have an eligibility criterion for listing of this single stock futures. So one, of course, it has to be listed on the NSE. Secondly, it has to be a constituent of the NSE 25. So this assists investors just to have different strategies in which they can deploy between using the single stock futures and the NSE 25 index, as shown there. Third criteria, it has to trade an average daily turnover of 7 million for 6 months prior to review. And lastly, it must have a market capitalization. So that stock must have a market capitalization of 50 billion shillings. So applying that criteria, 6 stocks jumped out. And so you have Safaricom, KCB, Equity, EABL, BAT, and ABSA. So these are the available single stock futures, and you can purchase any of these contracts on the next market at any given time. So you have the option now of buying Safaricom shares themselves, or you can buy Safaricom futures contracts. So both of them give you exposure in Safaricom, just that the futures contracts come at a cost, or come at a fraction, sorry, of the cost. So you don't have to pay the full notional, you just pay a fraction of that. Similar to KCB, Equity, EABL, BAT, and ABSA. So the contract size, again, for single stock futures, so for shares trading below Kenya shilling 100, so that's your Safaricom, KCB, Equity, ABSA. One contract equals 1,000 underlying shares. So if I'm buying one contract, Safaricom futures contract, that equates to buying 1,000 Safaricom shares in the spot or equities market. For shares trading above 100, and for our market, it's BAT and EABL. So one contract equals 100 underlying shares. So if I buy one contract of EABL, that equates to 100 underlying shares in EABL. So again, we try to keep this low, such that the cost of investment for investors will be low, as we'll see in the margin requirements for this market. Minimum price movements. So this is the tradable price movements for each of these securities. So for contracts below 100, so your Safaricom, KCB, Equity, ABSA, so we call it a tick size. So tick size is just the incremental movement in price. So Safaricom can move by a cent, so it can move from 40.00 to 40.01, or if it's going down, 39.99. For contracts trading between 100 and 500, so that's your EABL and your BAT, tick size is 5 cents. So say EABL can move from 150.00 to 150.05 or 149.95. For stocks or contracts trading above 500, the tick size is 0.25, so 25 cents. So as of now, none of our listed securities is above 500, but there are times in which BAT can cross this threshold. Then we'll have to adjust the contract specification for this. Contract months, so listing months, settlement price, and expiry dates, they are just similar to the index futures contracts. So quarterly contracts, so March, June, September, December, settlement is cash settled in Kenya shillings. However, for single stock futures, with the operationalization of what we call securities lending and borrowing market, SLB market, and short selling, then we can move this from cash settlement on maturity to physical settlement, whereby the buyer, if he holds a contract to maturity, then we'll expect physical delivery of shares into his CBS account, and the seller will need to facilitate that. But for now, we do cash settlement, and cash settlement is just paying the cash differential from the previous day settlement price to the final day settlement price. Settlement price and expiry dates are just similar to the NSE 25. So I'll just walk you quickly through trading fees and what you need to be cognizant of as an investor in terms of costs that you need to pay for a transaction. So for single stock futures and index futures, as shown there. So for the NSE, there is a fee of 2.5 basis points or 0.025%. Clearing member, 2.5 basis points. So clearing members, as per regulations, clearing members are your clearing banks or banks that facilitate clearing and settlement of transactions. Then they are allowed to charge 50 to 100% of what the NSE charges. And so taking 100% of that, so they're allowed to charge 2.5 basis points, similar to the NSE. Trading member is similar to a broker. And this, in this instance, is just FXPesa. So FXPesa, as per regulations, is allowed to charge 0 to 400% of what the exchange charges. And since the exchange is charging 2.5 basis points, then 400% of that will be 10 basis points, so 0.1%. So then there's a statutory investor protection fund levy of 0.01%. And this is just to assist clients in case of malpractice by their broker, then they are able to have recourse to this fund. And this is just similar to what we have in the spot underlying market, share market, where we have the investor compensation fund. Then the CMA as the regulator then takes 1 basis point or 0.01%. So total for one side of the transaction, then you're able to pay, you're only allowed to pay 0.17%. So for round trip would be 0.34%. And for the index future, total round trip will be 0.14%. Compare this to the spot market or underlying market, whereby the fees range between, let's say, 1.5% to 2%. So it's almost 10 times cheaper for you to trade in terms of fees. And this is also another reason as to why derivatives markets are very popular. Cost of entry is low, and also the requisite fees are much lower. So assuming a transaction worth 1 million, it will only attract a fee of 1,700 shillings. So much cheaper for investors. So lastly, just before we look at benefits and risks, so we look at your initial investment costs, what you need to pay upfront for you to have exposure to some of these contracts, and they are shown there. So we have March expiry, June, September, and December. So the March already expired on 18th of March. So we currently have June 2021 expiry, September 2021, December 2021, and March 2022. So in terms of initial margin, so initial margin is a good faith deposit that you need to pay for you to be able to just buy or sell one of these contracts. So for Safaricom, it's 3,300, and it's shown there. For KCB, 4,800, for equity, 4,600, for ABSA, 1,600, for EABL, 2,300, BAT, 4,900, and then the index, 40,300. So what this simply means is if you pay 3,300 to the exchange, then you will be able to have exposure worth 1,000 underlying Safaricom shares. So you've bought one contract, which equals to 1,000 underlying shares by only paying 3,300. If you're going onto the spot market, and just for comparison, if you wanted to buy 1,000 shares in the underlying, you'd pay current market price, give or take 40 shillings, multiplied by 1,000. So that would be 40,000. So you're only paying a fraction of this. And that's why futures markets are quite lucrative, especially in more developed nations, because cost of entry is low and requisite fees, again, as we say, they are much lower. And so we can see that these really are much cheaper for you to really invest, and it's something that you really should have wind of and seriously consider for your portfolios. Why the NSE 25 share index is much more expensive than the other contracts? Remember, the NSE 25 gives you exposure to 25 stocks. So by virtue of that, and also its contract size being a bit larger, then its initial investments or initial margin requirement is much higher compared to the other contracts. However, we really are in the process of listing a smaller, or what we call a mini index. So a mini index will be, give or take, 10 times much cheaper to invest in, and this is by virtue of us reducing the contract size. So subject to just final regulatory and internal sign-offs, then we'll be able to offer a much cheaper index contract for investors to take advantage of and get exposure to the broad Kenyan equities market. So quickly, just to walk you through the benefits and risks, just in view of the time. So benefits, so we have hedging. So hedging really is whereby an investor has an exposure in the underlying market. Assuming I have Safaricom shares and I don't want to sell Safaricom, and I have a feeling that Safaricom going into the BBI period, going into 2022 elections, I'm unsure of the price of Safaricom. Then I can take an exposure in Safaricom futures and just protect my portfolio against adverse price movements, and ideally just smooth out my returns. Additionally, it offers wider variety of trading strategies. Remember, the only way in which investors knew how to take advantage of opportunities at the NSE was to look at a stock, buy the stock, wait for it to appreciate, and wait for dividends. But now with the futures market, then you have different trading strategies that you can employ, and different ways in which you can make money in the market. Whether the market goes up or down, then you can create different strategies for you just to profit from that. And some of those strategies really are like shorting securities. So the futures market offers you avenues in which you can short. You can replicate the index by investing in the index futures contract. There's arbitrage. There's also what is known as cash equitization. So different kinds of strategies in the market. Then there's enhanced return due to leverage. Remember, your initial investment costs are much lower, so your returns will be enhanced due to the much lower costs. Lower transaction costs, as you've seen, fees are at 0.17% and 0.14% compared to trading fees on shares, which can range between 1% and 2%. And then there is lower counterparty credit risk by virtue of having the NSE and the clearinghouse ensuring that contracts are settled on a day-to-day basis. And so investors really don't need to worry about counterparty credit risk and their counterparties by and large. Going into the risks, so there's leverage. So remember, we said you only use a small, your initial investment is small. So leverage is a double-edged sword. So while it benefits an investor by enhancing your returns, also then it can magnify your losses in that your initial investment can be quickly wiped out. So you need to be very cognizant of that as you're coming onto the market. Issues of default. Whereas really, even if you look at global markets, there have not been defaults of clearing houses, but we also need to be cognizant of that. Black swan events happen. Who knew there would be COVID? So while this has never happened, then we also need just to be careful that a default might happen. And so just having that comfort that the NSE Clear has and the NSE as the exchange has sufficient resources just to ensure that settlement always happens and all obligations of market participants are met, and ideally all issues regarding the market are catered for. Then there's market risk, and this really is the normal issues of price movement. So if you buy, let's say, a futures contract, and then instead of going up, it goes down, so you're exposed to market risk, just similar to any investment that you have. Liquidity risk. This is really the risk of not being able to exit a market or enter a market at will. But this has been really catered for by having a market maker. So we've been able to onboard a market maker who's able to give two-way quotes in the market and match investors as and when they need to enter or exit the market. And lastly, really is on operational risk. So this is just issues to do with people and systems. Just ensure that you have adequate policies to ensure that and ensure that staff and investors are trained just to ensure that you avoid unintended losses coming from this market. So Edwin, just allow me to stop there and just hand it over to you for the demo, then before we handle the Q&A. Thanks.
So I'll share a very short pre-recorded video. So I hope you can be able to view it on your screen. I'll basically demonstrate how to execute the basic commands on the FXPesa trading platform. So the first thing is to ensure that you have registered by opening an account with EGM Securities in order to access these assets. So I will briefly discuss how to place a trade on the trading platform, how to execute risk management parameters, and how to close the trade. So the first thing, I'm using the mobile app. The first thing is to download the platform. So it's available both on Play Store and App Store. So this is how the app looks like. So once you've downloaded it and having registered with FXPesa, then you click on the app. Then it will be launched on your mobile phone. So you will get the login button. So you click on it. It's at the bottom of the platform. You will input your account number or account ID. You will also input your password below that. Now, we offer two types of accounts. For new traders, we recommend you to apply for a demo account. Demo account comes funded with $10,000 worth of dummy money so that you can practice without risking your funds. So we also have a live account. Live account is where you deposit money in order to start trading real money. So once you have inputted your details on the two slots, you will select the server accordingly. So this happens to be a demo account. So I have to click demo so that I can gain access. So once you're in the trading account, this is how the interface looks like. Besides NSE derivatives, we also have other international financial instruments. So we have Forex, we have commodities, we have stocks, we have international indices, and the last asset class is NSE derivatives. So if you look at the top of the platform, you can get to navigate and select the asset class that you're interested in. So NSE is on the far right end at the top. So once you click on NSE, you will get the 7 instruments that are on offer. So one is NSE 25 and the rest are single stocks, derivatives. So depending on what you want to trade, you have to click on the respective instrument. So in this case, it's Safaricom. So you'll just click on Safaricom. So once you click on the particular instrument, you will get this dialog box. So on this lot, you can see there's somewhere written volume in lot. So this is where you specify the contract size. So once you input the contract size, you can then move ahead to input the risk management parameters. So you can click on stop loss. And we also have take profit. So basically, you're capping your prices on the profitability territory as well as the loss territory. So you can put the number of points that you target as profits and the maximum points that you'd seek to have the trade closed to minimize the loss when the trade goes against you. So like in this case, by putting 40 points, it basically means that the price has to drop to 38.30 for you to lose 37.47 as the maximum loss on this trade. Else, if price goes the way you had anticipated and you make 80 points, price has to rise to 50.30 for you to generate a profit of 74.94. So once you've added those two parameters, you can then click buy button below your platform. And just to mention, it's not a must for you to put these two parameters, but again, it's very important just to ensure that you're not exposing yourself to too much loss. So once you click the buy button, you will then click continue trading button at the bottom, and your trade will be executed and it will show you that that trade has gone through successfully. So for you to know the status, you will need to click the navigation buttons at the bottom of the platform. So the menu is at the bottom. So the second option from the left, once you click on it, the two arrows pointing in different directions, you can be able to see trades which are already running. And if you go at the bottom, you will notice that our contract has been executed. So it's just a matter of time to wait until your trade has gone into profitability. But again, depending on the options that you have, perhaps you might deem it fit to close that contract and take another opportunity that might be ripe. So you can close your trade at any time. If you have a running trade, you can actually click on that trade and you can be able to modify the risk parameters. So for example, if you had executed the trade without putting those two parameters, so long as that trade is running, you can actually click on a running trade. And once you click on it, you can either modify parameters which you had set before, that is stop loss and take profit. Or if you had not placed those parameters in the first place, here you have a chance to include those parameters. So clicking any running trade, you have the options to either modify or to put the risk parameters all together. So once you're through, you will click modify trade at the bottom, the option on the right. And once you do that, you will then click continue trading, and those parameters will be updated on that trade. Lastly, once you want to close your trade, you'll just need to click on it. So in this case, if we click on Safaricom again, you can actually click the close button on the left. So as you can see, we have a close button on the left and we have modify trade. So if you want to terminate your trade so that you can crystallize whatever you have made, you'd need to click on the trade which is running. So in this case, it's Safaricom. Once you click on it, you will get this dialog box, and you can click the button on the left side at the bottom, the close button. So once you click on it, your trade will be terminated once you click continue trading. So it's a two-stage process, because you can click a trade without the intention of closing it. So once you click continue trading, that trade will be closed, and you will need to click on the fourth icon at the bottom. So we say that the navigation platform, the menu button is the 5 buttons which are at the foot of the interface. So if you click on the fourth icon from the left, you can be able to view trades which you have closed. So in this case, you will notice that we had 2 trades closed. So we had Australian dollar, Japanese yen pair, and we also have Safaricom, which we closed in this demonstration. And that's pretty much it on my side. So for more information on how to run the trading platform, you can join us in our weekly webinar sessions. So every Wednesday, starting from 6 p.m. and every Saturday, starting from 10 a.m., we normally hold training sessions for those of you who might be interested. And that's pretty much it. So I'll now invite Geoffrey to give or to pose some questions that we might have received from the audience.
Sure thing. Thanks, Edwin. I've just been answering a number of the questions, but I'll just read through them again, just for the benefit of everyone here. Some Rufus, I believe, has covered as he was presenting, but no harm in just looking over them again. So one was, derivatives similar to indices, and are derivatives linked to single underlying assets, or can a single derivative include different assets? So indices, really, you can look at them as being a standalone product in themselves, because remember, the derivative will always be based on some underlying asset. So you can't have a derivative on its own. There must always be some underlying asset. And that underlying asset can also be an index. An index, very simply, is just a benchmark or an aggregation of the performance of some constituents. So Rufus talked about the NSE 25. So the NSE 25 index, before this derivatives market came along, the NSE 25 index was just a way of aggregating the performance of those top 25 counters to then give you a proxy measure for how well the market is doing by virtue of those top 25 counters trading. So when the derivatives market then came in and these products came in, we now have the possibility of creating a derivatives contract, a futures contract in this case, that's based on that index. So you can still think of indices as underlying securities, albeit non-tradable, unless you're using vehicles such as derivatives or ETFs. Typically, derivatives are linked to one underlying asset at a time. However, you do have in other markets more sophisticated derivatives or hybrids, essentially, that can combine different types of underlying assets. But those really are, I'd say, few and far between. For the majority of the cases, you have a one-to-one relationship in terms of one underlying and the derivative contract. Can we trade options on NSE? Also covered by Rufus. So we have futures contracts available at the moment. And as the market then develops, we would look at expanding the underlying asset classes for futures contracts, and then also look at introducing options contracts. So options bring with them another layer of complexity and just slightly different mechanics. So that would really come as market development progresses. Any taxes on your derivatives profits? No, there's no taxation. In fact, on generally your capital markets securities products are not subject to taxation, except for in the case of shares and bonds. Those proceeds you receive in the shape of dividends or coupon payments would face taxation. But again, here we're talking about the derivatives market. And one, by virtue of the fact that the derivative itself does not give you ownership of the underlying asset, then there's no dividend, there's no taxable dividend to worry about, right? And as far as your gains, your profit and losses on just the market swings from trading these contracts, you are not liable to pay any taxes on those. Underlying asset we spoke about, so that just points to what is the underlying security or instrument. So we saw the list of contracts we have. So Safaricom, KCB, Equity, ABSA, BAT, and EABL, those are our underlying assets in this case. And specifically, those are the underlying single stock futures or single stock shares. And likewise, for the index contracts, then your underlying asset is the NSE 25 share index. If I take an ABSA contract of 1,600, how will I benefit? So the 1,600 shillings is your margin requirement. And margin is just a good faith deposit that you log with the exchange, and it's refundable. So we're just holding on to that for as long as you're holding your position. Once you exit the market, those funds are returned to you. In terms of how you then go on to benefit from holding that contract, that depends on your trading view. So if you have a bullish view of ABSA in this case, you would be buying or going long those futures contracts and expecting the price of that company to appreciate. And that's where you would make your money. Rufus spoke about the contract specifications. So in the case of ABSA, for example, essentially we're saying 1 is to 1,000. So for every shilling that ABSA then appreciates, you are making 1,000 shillings on that movement. If on the other hand, you are bearish or just have a negative sentiment around the company, you can take a short position, which means to come in and sell futures contracts on ABSA. And you then be profiting from that downward movement in prices. I think some new questions are coming in. Maybe just jump to those ones quickly. I think the FXPesa team maybe can answer as far as technical analysis on MT4 for this market as well, but I believe that should be available by virtue of the trading platform that FXPesa or EGM is now offering you. There was a conversation around a mini index, so that is something that is in the pipeline. So you may have noticed in the presentation that the margin requirements for the current index contracts are sitting at around 42,000 shillings. And that one index contract then exposes you to anywhere between 300 to 400,000, depending on where the index is trading. So a mini index would then step down the size of that contract, making it quote unquote more affordable, just in terms of lower margin requirements and of course a smaller exposure per contract, just to give the retail segment a lot more flexibility in terms of how you would trade this. From the demonstration, I think we saw this is quoted in shillings, so pretty much what you're used to or comparable to what you'd be looking at if you're comparing other local products or even the actual shares in the market. Example on trading, NSE 25, looks like normal trading. So yes, in effect, the same way we saw the demonstration of trading Safaricom futures, you can then trade the NSE 25 share index futures the same way. It's just that now the pricing is quoted in points rather than shillings, right? So today the index could be trading at 3,600 points, and that's what you would see quoted on the screen. And so your bid offers are then quoted in points. And yes, there is leverage in the sense that, as Rufus mentioned, that current index contract is in exposure terms worth up to 400,000 shillings, but we're not asking you to put down 400,000. You are just required to have that initial margin requirement. So in that sense, leverage is built into all of these products. Touches on the next question, how do I set leverage? So in effect, with these products, the leverage comes in by virtue of the fact that the exchange has already published the margin requirements. As Rufus said, give it a ballpark figure of around 10%. So Safaricom is currently trading at around 40 shillings, but you're only required to put down 3,800 shillings per contract. And each contract is worth up to 40K. So you're playing at just below 10% there. Let's see. Someone has asked about other trading members, apart from FXPesa. FXPesa should be your only trading member, but feel free to look through the NSE website just around even the clearing members that are licensed to operate in this market. Short sale procedure, we'll just take a couple more in the interest of time. We can just open it up some more. So short selling really is, in this market, you're just taking a sell position. You're a net seller. So today I could decide the sentiment maybe on banks is a bit negative. I would like to short KCB, for example. In order to do that, I just need to sell KCB contracts in the market. You can sell before you buy, and by doing that, you then have a short position. So you're expecting the price of that counter to decline, and that is how you would then see your profit. Yeah, and generally you can enter and exit this market whenever you want. There's no requirement to hold on to the contract even until it matures. So someone has asked, if the price moves in my direction, can I exit and take profits before end of contract? You absolutely can. You can open and close your positions the same day, the same morning, 1 minute later. It's all just dependent on your view and liquidity in the market. And of course, you can buy and hold your contract, or even sell and hold your contract until it expires. So there are no restrictions on our end as to how long you are required to hold a contract. That's purely comes down to your trading decision. So whether you feel you've made enough of a profit, you've essentially reached your take profit, or you want to exit the market before it moves further against you, then essentially your stop loss conversation. So no restriction as to how long you are expected to hold these contracts. Estimate of the mini contract, very soon. Very soon. I think we've been looking at it for a while. We should be able to announce something fairly soon. Okay, Edwin, Collins, is there anything else, or would you like me to just keep looking at the Q&A? I think I've touched on most of them. If there's anything,
I think you've covered majority of them.
Sure.
All right then. So at this point, we wish to bring this session to an end, and we'd like to thank you all for finding time to attend today's session. I hope you've been able to learn something, and I'd wish to encourage you to spread the word and have people benefit from these new assets. Otherwise, I thank you all, and I wish you a very pleasant evening. So see you all.
Thanks, everyone.
Thank you.
Thank you. Thank you, everyone.